Hello, YouTube. The stock market crash is getting worse, and we're seeing the biggest declines going back to December of last year, but they've always led to big gains. In October, we were in extreme fear. A year ago, we're in fear now. Do we buy fear or do we sell fear? And after the worst month on average for the last 30 decades, you might be really surprised as to what's going to happen. But we have some breaking news, so things might change between now and Monday. The House passes a bill to avert the government shutdown and sends it to the Senate. We'll see if that passes, but there is going to be no relief for student loans, which are going to restart even if the government shuts down. So that's 28 million people are going to have to pay. So in the title of the video, we say that there's a 63% chance that this could happen next, and no one's going to believe it. Well, after the worst decline for the year on average over the last 30 years, I went back and crunched some numbers, and you might be really surprised to know that 62.5% of the time we close green into the next candle, and on average, we return about 1.9%. So unless it's 2008, maybe we're going to be due for a positive surprise. You might be pleasantly surprised. We're going to come back and talk about the seasonality chart too, because if we get a little bit of a lower low, maybe that failed breakdown I've been talking about for some time could finally play out and give us a Santa Claus rally. But I know what the bears are thinking. They're saying, oh my God, government shutdown. That's it. Cancel the stock market. Take it down to zero. But this time it's going to have to be different. It's going to have to be 2008 for us to basically go down. Looking back to the most recent periods, we note that in 2018 and 2019, we closed up by 5%. And in 95, 96, we closed up positive too. And people don't even really notice when a government shutdown happens. So they don't even notice it at all. We're also going to go through what could go wrong with a government shutdown. And we're going to talk about what could go right. There's frankly just a lot for both cases. So please bear with me as we go through our video. But I think a lot of it really depends on what Jerome Powell is going to say this week. What I don't want to hear him say is that they're actually pivoting. And the reason why is because as hawkish as he is, if he starts to say that we're going to make a pivot, well, that's usually when the biggest declines happen. Negative 36, 48, negative 27, negative 51, 58, or 35. We do not want to see a Fed pivot. We want to see a pause. So what I mentioned is that unless it's 2008, this could be actually pretty good. So for me, a big question on my mind lately has been whether it's 2007 or 2008, because we've raised rates for the most rapid increase going back to this time. And then from July of 2006 to July of 2007, they pause. The stock market doesn't crash until 2008. So the bears might be right. They might just be early. So we've now gone to 5.3 and we're starting to go sideways, which means no more hikes. So if it's 2007 and not 2008, well, maybe Jerome's a little bit bloated, right? He's like, oh man, there's like so much stuff I really need to do, but I think we got to trust the big man and see exactly what he has to say. So I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really appreciate that. And I thank you for your support ahead of time. All right, as we move forward here, this is going to really matter because when we have Jerome Powell speaking on Monday, I don't know what he's actually set to talk about. I tried to look through the Fed calendar. I couldn't find it. So this one here is a little bit to be determined for me. I'm not sure. JOLTS job openings will be important on Tuesday. ADP non-farm payroll looking to come in soft on Wednesday. But then we got the big daddy coming in on Friday, non-farm payroll and unemployment. So I think that these numbers would be interpreted as mixed because unemployment rates actually holding strong, which would mean no recession. And payroll numbers actually coming down a little bit would actually be constructive. So the way that I'm interpreting this data is that more people are coming back into the labor force. That's why the unemployment rate's going down, and that there's less jobs added. That's exactly what the Fed wants. So even if we're not going to get more data, well, this data is good. So let's end on a high note. What's so interesting to me too is that depending on how I word the question, retail investors don't really have a clear state of mind here. There's a trap being set. Who is it for? Well, these are within 24 hours of being asked as well. So they say that the bulls are being trapped, but they think that we're going to go up. This is a little bit confusing for me where people thought we were going to go down into this week. They were correct. Retail is usually not correct. But now it just seems like depending on how you word the question, they don't really understand what they're doing. They're getting emotional. We're also going to go through and talk about how leaders could lead and everything that can happen with tech stocks. So what this really means is that we're going to be going into a new month, a new quarter, and the last calendar quarter of the year, which means we really have to start thinking about where we could go into the end of the year. And we want to pick up on this tech story because I want to show you something here. So let's now take all these things back. Let's do that. Let me get rid of all my graphs here because as we now look here at a 12-month chart, let me just make sure I'm on the correct board. We go. Yes, I am. All right, here we go. Because as I looked at these different charts, let's look at a 12-month chart here for SPX. Well, we're green on the year, and I'll go to candles here, so it's a little bit easier to look at. 1 second here. Thank you for bearing with me. So we can note that we're up by 11% for the S&P 500 on the year. We're going to go through our YouTube list. So S&P up by 11%, not bad. The Nasdaq is what's really up, 35%. Right? We look here to let's look at RSP next. So equal weight S&P 500, man, it's up by 44 cents or 0.3%. I don't like the look of that. I look over here at the NYA or the New York Stock Exchange. We're up by 1.4%. I don't really like that either. We look over here at the Dow or DIA. We're up by 1.09%. It doesn't really look like the stock market is strong out there other than tech. Nope. Healthcare, which is a safe haven, is down by 5%. Let's look at financials. Financials are down by 3%. So when we're talking about the S&P or SPY, what this really means is that we have to understand what's actually inside of it. A lot of it is tech, and when we remove tech or make it equal weight, the stock market is basically flat on the year. So this will be so important for us because what I'm talking about here with leaders lead and followers follow. And again, if you want to see all of this commentary, I think I did post a lot of this on Twitter, so you can go follow me at Justin Caron, or I'll leave that link in the description in the comments for you too. But what this means is that the weighting for XLK is 50% Apple and Microsoft, or the two biggest stocks. And then QQQ is a better representation of the NASDAQ 100 or the broader tech sector. So what this means is that XLK went from an all-time high to make a new all-time high. And now we have that failed breakdown I've been looking for, just like we do on QQQ. But QQQ did not actually make it back up and form a new all-time high. So I'm hearing a lot of people talk about how the NASDAQ can make a new all-time high. Well, it really depends on what instrument you're looking at because the NASDAQ's doing it here. So we want to really make sure we understand the tech story. And what that really means is that I went through and did some more digging, and I found that ChatGPT is going to be releasing a significant update in the next 2 weeks. What's that update going to be? They're now going to be able to you can now prompt ChatGPT with pictures and voice commands. Whoa, that's a pretty big upgrade. Not only that, they now are no longer restricted to data from September 21st and knowledge cutoff after internet browser revamp. So it's now going to be real time. It'll be able to listen to look at pictures and interpret them, have a conversation with you. So you can give it a prompt like Siri. It'll respond back with you with a prompt. Whoa, this is like a pretty big deal. So if we think about these mega cap stocks like the Magnificent 5 or 7, well, this is from about a month ago, but we noted that the relationship between these two has been really unusual because red line goes down, black line goes up, black line goes up, red line goes down until recently. And now we know the 10-year note is breaking out. So we want to make sure we really understand the relationship between the 10-year note and tech stocks, but also what could come to actually justify these things. And this is on a backdrop that the Magnificent 5 revenues and profits versus GDP are looking weak. The big 5 is a green line. You can see they're back down to negative territory versus the broader S&P. So their revenues are also in question too. We want to see a reacceleration. So is that ChatGPT going to drive them higher? And then finally, because there's such a overweight of most funds into these stocks, 80% are overweight. Amazon, Microsoft, and Nvidia, well, they better deliver, especially going into earnings season. And as we think about the data that's going to be coming out, we want to think about that GDP, because if GDP is almost at 5%, updated as of today, the last calendar day of Q3 at 4.9, would it be reasonable to think that that's going to feed through to earnings? I think so. So maybe big tech is going to pleasantly surprise us. There's also a couple of other catalysts here. We'll come back and look at it in a few moments. But first thing I want to do here is actually get through these government shutdown notes. But then I do want to leave you with a lot of charts, because I think that we can listen to the charts for guidance. But as we're going into a new month, a new quarter, I really want to make sure we understand what could really drive the market. So I got 4 bullet points here for what could go wrong with the government shutdown. And like I mentioned, this is it's a fluid story. It's breaking news. I don't know what's going to happen by Monday morning. So I just want to look through what could go right and what could go wrong. So we'll go through those 2 things in a moment here. So here are the 4 things that could go wrong. The first one is that we can have a decline of negative 0.5% GDP loss per quarter. Here is Jeremy Siegel from the Wharton School of Business telling us that every week the government shuts down, shaves off 0.5 percentage point of real GDP. So if we're worried about going into recession, well, That's that's a doozy. That's bad. We do not want to see that. The next point here is Moody's. Why? Everyone's worried about a downgrade. Well, instead of telling Moody's what they're going to say, let's just listen to what they told us. While government debt service payments would not be impacted and a short-lived shutdown would be unlikely to disrupt the economy, it would underscore the weakness of U.S. institutional and government strength relative to other AAA-rated sovereign debts that we have highlighted in recent years. So what that means is that a government shutdown for a few days is not terrible, but the longer they're shut down, that could be bad. Going back to 2018, the longest one was 35 days. If we think about that, that's basically 4 weeks. So 4 weeks at half a percentage point, that's 2%. We can't really afford that right now, which means I'm what's that called? Cautiously optimistic that we can actually do this. And the reason why I'm interested about this is just because as we think about this, read the headline here because this is really important for me. McCarthy defies Republican hardliners but gets Democratic votes. What does that mean? It means that there's actually some wiggle room. I thought there would not be because it was Republicans with Republicans, but this is good. So maybe we're going to get a resolution, even if it's not going into tonight at midnight, which is the deadline. Maybe into Monday, maybe Tuesday. Maybe we get some fear, which could be good. We'll talk about that in a moment. The other things that could go wrong with the government shutdown is that there could be delays to things like federal pay for workers, passport renewals, national park services, economic data, and then certain government assistant delays. That's not good. And then also some economic data. So the economic data that we could be getting that comes out during this blackout period. And if we have a look here, it's not nothing. So it's kind of important. It's going to be JOLTS job openings, non-farm payroll, PPI, CPI, retail sales, housing starts, new home sales, Q3 GDP, and then that PCE inflation data as well. This will be so important because the Fed actually meets on November 1st. So we want to make sure we see all that data. And in terms of length, every 7 days matters. So 7 days, that's going to be half a percentage point of GDP. And the last one, the most recent one, is actually the longest one. It's 35 days under Trump. So we don't want to look for a 35-day one. That would not be good at all. So if we now go back here to the data that could drive everything else here, there's one last one here. If we get a downgrade by Moody's, basically their AAA sovereign debt, which is what they're quoting right here, I think that's going to really hurt the U.S. And it's going to hurt the U.S. because there's currently, I think it's $7 trillion in debt that's that's maturing right now. Let me see if I can find that article really fast because it's a pretty important one. Here we go. U.S. debt, 7.6 trillion. So the government has like a lot of money that's going to be maturing. And at a higher rate, like 5%, means they have to pay more interest. It costs more to service debt. So this is bad, but it's likely going to get a lot worse because as we looked at the projection from 2020 to 2023, 2020 to 2030, we got two lines here. We got defense spending, which is going to be the yellow line here. And then debt payments going to be the purple line. So eventually we're going to pay more to pay off the credit card than we do on military. And it's not because military spending is going to go down. It's just that interest rates are so high and there's so much debt that needs to get refinanced. Look at the number here. It's going to be 31% of all outstanding U.S. debt is going to you need to be renewed in the next 12 months. So if we're staying higher for longer and Jerome's Dr. Doom, it gives us no relief, that sweet, sweet relief, it's going to cost U.S. taxpayers a lot. I'm talking a lot. So that's what could go wrong. This is what the bears want to look at. So before we look at the charts, this is the narrative you really want to focus on here. But here's what could go right. What could go right is that Q4 performance after August and September are both sell-offs. This is from Cantor Fitzgerald. The average return is 8.73, a year's worth of gains into the last quarter. That's the Santa rally. Do we buy fear or do we sell it? Oh, crap. I kind of forgot about that. Buy when there's blood in the street. Buy the fear, sell the greed. That's correct. And then as I mentioned at the title of the video, the worst since indicator. So what this means is usually when we see readings like this, either immediately after or very shortly after, we will see the best months since. So the worst month of the year, the worst month since December of 2022, well, I showed you over here, right? It's no coincidence that we could be going up. So let's see if I can pull that back up here. It's these different months right here. I have them all highlighted. So we can go back through and we can look at the returns. We'll talk about that in a moment. But the worst month usually leads to the best month. So I think that's bullish. And then shutdowns have been a buy the dip opportunity buy the dip opportunity. So that's what's bullish, and we could go right into October. Now let's just look at two more quick things here because I think this is a little bit relevant. Fed's new inflation outlook already seems outdated, analysts say, and this is because the Fed's been behind. So Fed is unlikely to hike again in 2023. Let's read exactly what they're telling us here. We can see the graph, right? We're looking at this video because we like technical analysis. Well, are these lines pointing down or are they pointing up? Well, they're pointing down. That's pretty obvious. So core PCE must rise 0.3% per month over the next 4 months, or 4% annualized, somewhat faster than the pace this year. So we need higher inflation for the next 4 months and for the next 12 months in order for us to hit that inflation target from the Fed. It seems a little bit outdated, especially with the number coming in really soft on Friday. And here's a quote from John Williams, the second most important person at the Fed. Who is he? This is the New York president for the Fed. My current assessment is that we are at or near the peak level, the target range for the Federal Reserve funds rate. What does that mean? We're there. We're at the terminal rate. I think it's 2007, baby. Time to party, sing, and dance before we have tombstones coming shortly here. So, anyways, there's also some drag coming out of China. Let's just read these headlines here because they're pretty notable. China stock investors say worse yet to come in property crisis. Oh, great. Why? Well, look here, right? The property crisis voted as biggest risk. Second biggest one is geopolitical tension. So things are unwinding there, and that could have contagion or create some kind of credit event. A credit event just means when things start to go bad. That was like SVB or Silicon Valley Bank in March, which was what? Oh my goodness, was that the bottom? Oh no, that was the bottom. So we had our red month in February, a green month after SVB, and then we went up another 20%. That's right. I'm also looking here, foreign investors selling extended into September, which means they're just dumping it. They want to get out, and China poll respondents see room for gains through the end of the year. So with all this pessimism and fear, what could really happen that could go well? Well, we want to look at that graph here, which tells us after the worst month in September, what really happened. And unless it's 2008, which it could be, I just don't believe it is. I think the bears will ultimately be correct. I just personally believe they're early. And when I'm looking at the stats, well, just look at it here. The average return is 2% for the month, when we noted that the average return for the quarter is going to be about 8.7%. So what does that mean? It should be good, but then it should only get better. And if we have a red month, it's like a marginal red month, -3, -1. It's just the -17 that's bad. And if you look here to our most recent periods, what do we have? Well, big fat green, big green. This is a red month that goes back to last year, but then November is a power pump month. Oh my goodness. So that is incredible. If we look back in time too, well, let's just look back here to the 2000s. So we have 1, 2, 3 in a row. 1, 2, 3 in a row. Okay. What do we have right now? Oh, 1, 2, 3 in a row. Let's double check that one more time. Was the third one closer to a bottom or to the top? Hold on. So 1, 2, 3. These are lower lows. Let's not misinterpret it either, right? These are lower lows. The lowest one being at the bottom. For our current period, we're a little bit higher here. But then what happens? Oh, it's like a straight line up. It's an expansion. Cool. That's like a big gain right there. It is like a big gain from the end of September till the high that we put in a couple of years later. It's 100% higher, basically 92%. So unless it's big bad 2008, I believe we could be set up for a pleasant surprise. And what's so interesting about this pattern is that if we look here a little bit closer too, that seasonality chart we talked about before, where we could be getting that failed breakdown. Well, let's bring the lines back really fast here, actually, because the periods we're going to look at here, we're going to be looking back to every previous month here. So I just want you to note that, just look, it's not by a lot sometimes, but we get a little bit of a lower low. So a little bit of a lower low, boom, higher. All right. We look back to the next October here, lower low, boom, right? Failed breakdown right here, failed breakdown right here. We don't have the failed breakdown here. That's the part that's missing. I would have really liked to have seen that. That was the pattern I was relying on. But if that failed breakdown happens, like it happened a lot actually, by the way, too. So I look back over here, I was doing it, right? Failed break in 2011, failed breakdown in 2002. In 2001, it did not. And 2000, we just had a big dead cat bounce. So that was the first cut, which is kind of what happened over here too. So The first cut was not the deepest, as they like to say. So Santa rally, then cut, cut, cut. First cut, second cut, third cut. So the fail breakdown pattern, which I've been looking at on this one here, I'm thinking that it's, again, I can't say that I was right. I'm definitely wrong. But for me, if we get the lower low to hold here, or we get a marginal lower low and also reclaim and get back above 433, then I'll be looking for number 5. I'll say that history does not repeat itself, but it often rhymes. And as of right now, this still rhymes. And my default pattern tells us that we could be due for a 26% rally to hit a target of 5,500. So yes, I know things seem scary out there. Yes, I know like the data looks bad, but there's no time like the present. And we want to make sure we really understand what the charts are telling us. So that's pretty much it. I think there's a lot that I want to unpack during the rest of the week. So please make sure you subscribe to the channel if you want to see all those updates. But if not, the weekend deep dive from last weekend's now queued up here with a mega big bear thesis if you want to watch that. If not, thank you so much for tuning in, and I look forward to seeing you in the next video. Thank you again.